Good afternoon and welcome everyone to today's webinar. We'll be looking at the 2024 Q3 September market review. Today we have Krista Kerr and Frank Settino who will be providing a market update and comments on the current market conditions with recommended strategies. Frank will take a deeper dive then afterwards to review China's recent push for growth. He'll then switch gears to review the recent multi-strategy hedge fund boom. At the end, we'll save some time, as always, for your questions. Just a reminder before we begin that you should have at the bottom of your screens a Q&A icon. This is where you can click on the icon to type in your questions that might come up throughout the presentation. Again, we'll be accumulating them throughout, and we'll go to a panelist Q&A at the end of the webinar to answer and discuss your questions. A little bit about Kerr Financial. We're a discretionary portfolio manager with a fiduciary duty to act in the best interests of our clients. Our strategy is really to follow a disciplined focus on long-term investment objectives that yield the benefits in building and sustaining your wealth. We believe in the importance of diversification across asset classes, geographies, sectors, and companies, and we follow an approach to building multi-manager portfolios by selecting best-in-class investment managers with diverse yet complementary investment styles. Krista is our first speaker today. She's the CEO of Kerr Financial and is responsible for the overall management and leadership of our firm. She's highly accredited with multiple designations, including a CFA. She is on our firm's investment committee, and she leads our multifamily office division at Kerr. Our multifamily office division provides holistic financial services to support our high net worth families with multi-generational wealth stewardship. Krista is a thought leader in the Canadian personal finance industry. She's appeared frequently on TV, radio, and in newspapers addressing various financial planning and investment topics. Next up, we have Frank. He's responsible for our Montreal Investment Management Group, and he's on our senior manager leadership team. He also leads the investment committee here at Kerr Financial. He started his career at Tal Investment Counsel prior to Kerr, and he spent about 15 years as an equity analyst, helping portfolio managers in security selection as the Vice President of Canadian Equities. Frank is a CFA and a graduate of the John Molson School of Business. As we're nearing the end of 2024, it's been a strong year for the markets despite periods of volatility. So now to provide more insight, I'll ask Krista to turn on her video and she'll walk us through the details. Thanks, Krista.
Thank you, Kathleen. It's nice to be here with all of you. As usual, we've gotten used to doing these quarterly updates, and it's nice to have a chance to talk to you a little bit about our view. As Kathleen mentioned, we are going to talk a little bit about what happened in the quarter. We don't always want to focus on just the short term, but it'll give you some context for what happened, as well as what we think the outlook is for both the economy and markets. And we're going to start, as we often do, with a polling question to get some input from you. And once we've asked this polling question, I'll let you know why we're asking it. So if we can go to the question next. So you're going to see a little pop-up box, but basically what we were asking is a little bit of a reflection of what we've heard from some people and seen in the press. So we've seen quite strong returns in equity markets year to date through to the end of September, with the Canadian market up, 17% or so, and US markets up almost 25 or roughly. So with that strong backdrop, people are wondering what's going to happen. Are we at a point where we're going to continue to see some growth? So these options that I'll read out, because sometimes in the playback you don't see those. First of all is, will lower interest rates that we're seeing continue to fuel growth with markets moving higher from here? Secondly, certain sectors of the market continue to see positive returns, but others see some pullbacks? Thirdly, will markets be volatile but move moderately higher? And fourth, as an option, will we see a market correction given that valuations are quite high and given that we have continued geopolitical risks? So just interested to see your input to those questions if you want to select what you think is most likely going forward, fourth quarter or beyond, if you want to think of it that way. We'll give you a moment to enter your votes.
Yeah. All right, I'm going to close up the poll in a second if people can vote. All right, here we go. Ending the poll, and I will share the results.
Okay, so again, I'll read these out in case people don't see them later. So we had a tie in people selecting both 2 and 3. So 2 was that certain sectors of the market would see continued growth and some would see pullback. Number 3 was that we'd see volatility with moderate growth. And only one person seeing the very positive lower interest rates are going to fuel us to higher growth directly, and only 2 saying that a market correction is coming. It's a little bit of a trick question, I would have to say, because I think any one of those 4 things could be true in the short term. So I think we would probably lean towards maybe saying 3 or 2 as well, just as you did, that we're probably likely to see some volatility, but there's some reasons to feel there is a constructive backdrop in the economy. But there is truth to the fact that lower interest rates will continue to fuel growth, and we're going to see some positive returns. There's also a possibility at any time that you could see a bit of a correction. We had that situation early in August, and a 5 to 10% correction is a normal course correction in the market. So it's not terrible if we see something like that. So I think probably we would also say 2 or 3 like you, but I think really that's a short-term view. And what we really want to focus on, even though we will talk about that through this session, is that we want to always maintain a long-term focus on portfolios. And in the long term, good companies will continue to do well. And so sticking with a long-term strategy is probably the most important, in spite of the fact that we asked you to make this answer. So if I ask Kathleen to go to the next slide, it's really a summary of what happened in the quarter. And probably a lot of you are very familiar with seeing this, but really we did have quite a significant sell-off in the markets in early August for the first sort of 10 days or so, or through to the middle of August. But from there, equity markets did rebound, partly on, better numbers, better economic data coming out, but also largely at the end of the month because of the US Federal Reserve cutting rates. And that really probably was the most significant data point from an economic point of view, that the US Federal Reserve on September 18th, I think it was, joined other central banks with a significant cut. They hadn't cut rates yet like Canada had, or the ECB or the UK central banks, but they did step in with a significant rate cut of about 50 basis points, 0.5%. And that created a positive return both in the fixed income markets, which you can see did well when we look at those, and also to help fuel that growth in equities that happened at the end of the month. Behind the scenes, one of the things we saw in the quarter was a little bit of a leadership shift. So it will be familiar from previous calls that the Magnificent Seven stocks, which are primarily in big tech and communication services, those had really been driving returns earlier. You think of those Magnificent Seven stocks, you've got Microsoft, Apple, and NVIDIA that are all in IT. And then you've got Meta and Alphabet, which are both communication services. So those had been a driver of growth earlier in the year. And in the third quarter, we saw a bit of a shift. Those sectors had some positive growth, but much lower than other sectors. The ones that really felt benefit and felt positive returns in the quarter were ones that were interest rate sensitive sectors like utilities and real estate and financials. Those all saw some positive or more positive returns in the quarter. So a little bit of that shift and broadening out of returns that we had anticipated. Because of that, Canadian and international markets did better than US markets overall because of the strength of those big tech and communication services stocks in the US. And overall, we'll look at some detail of this as we talk, but overall, the global economy did remain resilient. And that really was reflecting a strength of the consumer still having funds on hand and still spending. a little bit more on services than on goods, but the consumer being strong, corporate earnings being strong, inflation stabilizing to a better rate, and rate cuts helping to offset some of the other data that was showing a bit of slowing growth and the continued geopolitical unrest that we've been seeing. So really, the economy remained resilient through the quarter. This is a little bit of a slide that shows, again, the detail of what happened in equity markets. So this is the period from July 1 to September 30th, and it's looking just at the S&P 500 as an example. But you can see the market started off positively. There was a little bit of a dip around July 24th, which partially was a concern over valuations in the big tech stocks. But then we really saw that sharp sell-off early in August that lasted for about 10 days or so. And that was really a combination of a couple of things. First of all, there was a weaker jobs report that came out, and that made people worry if the economy really was going to soften and if the US Fed had waited too long to drop rates and we were going to see movement into a recession. There was also some concern about the tech valuations being high if there was going to be a slowdown. And then one thing that was sort of marked, but a little bit of a technical item, was that the Bank of Japan increased their interest rates at that time, which, you know, you'd wonder, how does that impact everything? But there were a number of people that were borrowing the yen at low rates in order to invest in markets. And when the rates increased in Japan, that carry trade unwound, and that caused some ripples through global markets. So for those reasons, we saw that sell-off in August, but within a number of 10 days or so, we started seeing really positive corporate earnings reports, and there was some data that was coming out not too bad in terms of global economic data. We saw some better reports, and then also the US Fed was signaling that they would likely cut rates. So all of a sudden, we saw a nice recovery that erased all of those pullbacks, and the market recovered. And you can see later in the period, if you go to sort of September 18th, 19th, you can see after the Fed did reduce rates, the last number of days of the quarter were very positive again. So we ended up positive overall, but it was a little bit rocky during the quarter. Now, these slides are the usual ones we've included just to give you context on what happened in the market. So the bar to the far left, which is in purple, is the quarter. The blue is year to date. The third middle bar is in red, and that's the 1-year numbers. And then you see the longer term numbers, which are really the most important ones. But if we look at what happened in the quarter, you can see cash was still positive at 1.2%, a little bit less than a quarter of the annual rate because cash rates started coming off a little bit in Canada. But still a positive return on people's cash while they were waiting to deploy it or holding for reserve. The positive return in bond markets, you can see though they were up 4.7% in the quarter, and that really was a reflection of the central bank rate cuts. And you can see that 4.7% return in the quarter has led to a positive return now year to date for bonds. So it was positive bond numbers. In the equity markets, if you jump over to the US, you can see what we said. The US was only up 4.5% in Canadian dollars, a little bit less than other markets because there was that pullback a little or less rotation out of the tech and communication stocks. And you can see the Canadian market really benefiting from the lower rates with a 10.5% return, 6% from the EFI market, the international markets, and 7.5% from emerging markets. So positive equity returns overall, and all of that rolling up if we use our balanced benchmark, which is a combination of all of those, to about a 6.3% return in the quarter, which means a 12.3% year to date and 21% for the year. So that it's been a very strong year in markets, recovering off of our 2022 numbers. You can see also longer term, we're looking at that 6 to 7% return in a balanced portfolio. This just reinforces, I guess, what we were saying about sector returns. So to the far right, you can see technology and communication services, rather, which are the very strong returns for the year to date. They were only up 1.6 and 1.7% respectively in the quarter. Whereas to the far left, you can see the more interest rate sensitive sectors like utilities and real estate, and financials and industrials, they were up more for the quarter. So, real estate up 17%, utilities up 19.4%. So you can see that sort of rotation in where the leadership came from, or that broadening out of returns in the quarter. And you see that similarly on the next slide, which is looking at the factors that we have. So where quality and growth have been the best performing factors for the year to date. In the quarter, you saw good returns from dividend bearing stocks, which tend to be those stock, the high dividend payers sometimes come in the financials and utilities sort of sector, also in value and small cap. So those things doing better than the growth stocks in that particular quarter, but still seeing a lot of leadership from growth in the year to date numbers. So this really just sort of reinforces a little bit what we said at the beginning. We think that while we have to recognize that there are both positive and cautious factors that we have to keep an eye on. The positive factors, or the tailwinds, have been outweighing the headwinds. So we've had that resilient economy overall. But in the quarter, the positive things, the central bank starting to cut and knowing that lower interest rates will spur economic activity and support valuations. Sometimes that happens with a lag, though. It doesn't always happen immediately. People have been saying what's going to happen with housing now that rates are coming down. It'll probably take a little while for that to work through the numbers. But that's a positive factor, a tailwind for the economy. Inflation has really stabilized, and people probably saw this week that Canada announced a September inflation CPI numbers only at 1.6%. So we've really come a long way, reducing that from the 9+% that we saw in the pandemic. Corporate earnings have remained very strong, and that's been good. And the consumer has still been strong. And particularly, you're seeing the consumer continuing to spend on services. So I think when you look at where spending is, there's been a little bit of a hesitation. We don't know how the market is, so we're going to be careful with buying our big durable goods. We might hold off on the appliances and other things, but we're still going to go for experiences and continue to travel and do things with our families. So a little bit more activity on the services side. And those things have all been positive, and they've been supporting that greater chance of achieving that soft landing and having lower risk of recession. So those all give us a good reason to feel constructive going forward, but we also recognize there are a number of things that we have to keep an eye on. So we are seeing a little bit of signs of the labor market cooling slightly. There was some concern about that through the quarter where people said, oh, we're seeing some worse jobs numbers. Is this going to be a real sign of recession? When you look behind those numbers, it seems to be that there are new people entering the job market, including immigrants entering the job market, and it's not really been a sign of big layoffs to date. So maybe not as bad of a factor as people think, but people have been watching that. And then some parts of inflation have stayed sticky, like shelter has stayed a little bit stickier than other, and that usually is a lagging indicator as well. And as I mentioned before, while interest rates are very helpful going forward for the economy, they sometimes don't translate to immediate action. So, the housing market may not immediately respond to those lower rates. It might take a little while, but still, it's generally a positive factor. As I mentioned before too, while the consumer is still spending on services, they may be putting off some of their durable goods purchases. So manufacturing activity has been a little bit lower. And then I think, most importantly, as people probably recognize, that we have continued geopolitical risks, with continued activity in the Russia-Ukraine war and in the Middle East, and escalation in those fronts, which is possible, could impact sentiment for consumers and for corporate sentiment, and that could impact markets. So you have to keep an eye on that very closely. The U.S. elections, we talked about at a previous webinar that we don't think it's going to be the only driver of a direction of the market, but it certainly does add some uncertainty as people try to sift through what's going to happen in the U.S. in less than a month's time. And then valuations are high. I don't think that means that they're high across the board. You know, there's certain sectors are higher than others. And it also doesn't mean that you can't see positive returns off of high valuations or full valuations. But what you do need to watch there is if there is some varying data that comes out. If you see some blips in the economic data, when you have full valuation, you can see pullbacks and volatility in the market. So that can add to volatility. So I think these factors mean that we can't say we're at a zero risk of recession, although we think generally the factors on the left, the positive factors, are much stronger. We need to keep an eye on the risks, but we generally feel there's a constructive backdrop. This was just put in just as a reminder of what the central bank's duty is, and specifically in the U.S. Federal Reserve since the 70s, they've had this dual mandate where they have to both focus on maintaining maximum employment, which might not be 100% employment, but it's sort of the maximum level of employment in a normal market cycle. So they want to focus on employment, and then they also want to focus on price stability and keeping rates at moderate levels. So in the past few years, with inflation being so rampant and rising so rapidly, the real focus has been on number two, raise rates to keep inflation in check and try to keep prices stable. Now that that's coming under control, the central banks are now able to focus back to focusing on employment and stimulating economic growth. So that's why we're seeing this shift on the most central reserves, central banks reducing rates. So the next slide looks a little bit at inflation. And this is an interesting tool that you can use. If you go to the US Bureau of Labor Statistics and you get this chart, you can actually click on any of the underlying items to see what the graph looks like. And one of the biggest drivers of inflation coming down has been the reduction in energy prices. But if I included energy in this graph, the other lines all become so small that it's hard to see any variation. So we are seeing the long-term all items, which is the red graph, coming down. In the US, it was down to 2.4% in September. In Canada, we just saw that CPI came out at 1.6%. So that's a big drop from the highs that we saw that were, in the 9% range in 2022. The biggest, you can see a number of things, but the biggest one isn't on there, which is the energy prices that have come off, which have allowed that to happen. But also food, which is the blue line, you can see was way up and it's coming down. Shelter is also coming down. That's the purple line, but it's coming down a little bit more slowly. So I thought those were a little bit of interest to isolate there. Of course, this doesn't mean, if you go back for 1 second, that inflation is not an issue for people anymore. This is the rate of increase in prices. So our increase in prices are coming back down to a very reasonable rate, close to the targets of the banks. Of course, we haven't seen negative price increases. So people are still paying more for things than they were before. And that's why inflation is always still a big issue for elections and other things. So the next one is just a quick look at labor markets. You can see unemployment where it ticked up drastically during the pandemic and then had really come down to below 4% for quite a bit of time over the last few years. We saw a little bit of a tick up in August, September that people were watching. But as mentioned before, some of that is not really layoffs. There hasn't been from layoffs. It's been from look at new entrants into the market. So we have to keep an eye on that. But again, both of those things, the dropping inflation rate and the slightly higher unemployment, have led the banks to be able to drop rates. So this was really looking at the US Federal Reserve, which, as I mentioned, in September did decide to cut rates by 50 basis points. This sort of was a signal that there was a new monetary easing cycle coming, and Chairman Powell talked about this as a recalibration to manage economic risk, but also said that future decisions will depend on data that comes in. One thing that's interesting is the neutral rate has been slightly increased to almost 2.9%, 2.875. So we're saying that we may not go down to those zero rates we had before. But you can see at the various meetings, including the September one, which is on the bottom line, the September meeting, the consensus of the participants was that we might get down to 4.4% rate in the US by the end of the year from the current rate of about 4.9. And then see another 1% drop to about 3.4 by the end of 2025 before settling in at that neutral rate of 2.9 in 2026 and onwards. So that's sort of what the US Federal Reserve is looking at. We'll have to wait and see what the next meeting in December has. Bank of Canada has been cutting a little bit faster. You can see right now they're at about 4.25%. They think neutral in Canada would be about 2.75, in that 2.25 to 3.25 range. And investors are sort of betting that within a year or a little bit less than that, we'll be back down at neutral. There has been some debate about what the next rate move would be by the Bank of Canada. At one point, because the economy was struggling a little bit more, there were a number of people who felt we might see a 50 basis point cut at the next meeting, which is October 23rd. Then we saw some better numbers come out in September. And so other people felt it might only be 25 basis points. So there's a question of where we'll be there, but we are going to continue to see some rate cuts across the board, ECB also. So one thing we're seeing, and just as you saw in those bar graphs for the third quarter, countries and sectors are recovering at different rates. So from a geographic point of view, US has been really dominant and remains a resilient economy. Canada had struggled a bit more, partially because our household debt, we rarely take a 30-year mortgage. We don't have such things here. We have more like 5-year terms. And so the Canadian consumer has felt high interest rates faster. So we've struggled a little bit more. Europe is starting to see some good growth, but a little bit more in Mediterranean countries than in Germany and other places. And then China, as Frank will be talking about a lot more, has been struggling a little bit for various reasons. And we do expect some positive growth, but not as high as in the past. So this means that there are some different opportunities across geographic markets. And we think while the US still remains resilient and is a good place to invest, there may be continuing opportunity for some growing returns for markets outside of the US. And then by sector, again, the same thing we saw in the third quarter is we saw some rotation away from IT and communication services to the other sectors. We may see some continued opportunities in more value and smaller stock names. Not that we would go away completely from the growth or the IT sectors, et cetera, but having that broad diversification is beneficial as we might see some returns diversify. So thinking forward, we're generally constructive on the backdrop for the reasons we've been talking about. So inflation moving in the right direction, slightly softer labor markets, but not a big layoff situation. But that means we'll likely see some rate cuts continuing. Those will help to spur economic activity and be supportive of valuations. Corporate fundamentals seem strong, and the consumer thus far is stable. So those reasons are the most important reasons we feel fairly constructive. However, we still want to be vigilant to risks out there. We want to think about those geopolitical tensions and watch them regularly. While we think it's a short-term factor, we are keeping an eye on the US election. Frank will be talking about China's slowdown and the impact of China on global markets. And then because valuations are a bit stretched in certain sectors, the markets may be volatile as we go forward. So we want to keep that in mind. And then I think a longer term, beyond the short term, maybe in the midterm, we have to keep an eye on sovereign debt levels because many countries continue to run big deficits and large public debt loads, and that's going to have to work itself out as we go. So overall, our positioning really has not changed. Again, back to that beginning comment, we want to invest for the long term. We want to continue to have good things in your portfolios that make sense for the long term. But because we have seen some concentration in US markets in certain sectors, we still want to have diversification there. So we want to have a diverse geographical equity portfolio. We also want to have diversification to manage some risks and volatility volatility and to take advantage of parts of the market that maybe still are not fully valued, like those ones that came back a bit in the third quarter. We always want to, because of the potential volatility we see, we want to have quality companies that have strong balance sheets and where we have visibility to their earnings. And on the fixed income side, we don't see a lot of reason to extend duration. So we're remaining fairly short duration as a focus, which, you know, in the third quarter, longer duration helped a little bit, but I think it still makes sense given the risks out there and given where we see opportunities to remain fairly short duration and still in favor of investment grade corporate bonds. So that's not a big change from where we've been, but that's sort of why we are where we are. So with that, I'll pass it back to Kathleen and to Frank.
Thank you, Krista, for walking us through the market update. I'm going to ask Frank to turn on his video and mic, and we'll lead off this section with another polling question. So I'll just launch that poll so you can see the information. So I'll read it out again because it doesn't always come in when we're in our recording. So when you hear we'll be discussing China's markets today, what concerns or questions come to mind for you? 1, how will it affect global investments? 2, what opportunities might arise for investors? 3, how stable is China's economic growth? And 4, I don't have specific concerns, but I am curious to learn more. So I'll give you a few more moments to input your answers, and I encourage you all to put something in there and we'll have a look. I'm going to end the poll in a few seconds here. Get your last answers in, ending. Now I'm going to share the results and I'll ask Frank to make some comments.
Yeah, I think the first one, and the overwhelming amount of respondents responded to how stable is China's economic growth. That's, people are interested in learning about that, and I think there's even an amount of individuals that are just curious about how it affects global investments and maybe the opportunities that might arise for investors. Which, you know, I think the three options were all very valid and reason to kind of be interested in China. So, you know, when we talk about China, it is the second largest economy in the world. There's 700 million in the middle class that are consumers of goods from developed countries. So it has an impact on companies like Apple and LV, Louis Vuitton and other major brands. So it's important that we understand how strong the economy is in China. I know it's a little distance for us in North America, but it has repercussions on everything from resources to consumer goods. So our first topic will kind of examine the strong rally we saw in the Chinese markets and try to frame whether that price strength is sustainable or whether it's vulnerable to fizzle out. And our second topic that we'll touch on today, we'll touch on hedge funds, and more specifically, the structure of multi-strategy hedge funds. We'll touch on why this category of funds has garnered a lot of attention from investors, and we'll kind of try to go into detail of why we think they're pretty attractive alternative investments. So let's move to that first slide. We're on the first slide where we look at the Chinese equity markets. So for a long period of time, I think since 2022, we've seen Chinese markets underperform global markets. And in fact, in 2023, the MSCI China index was actually down 11%, whereas most global markets were up double digits. However, I guess the news of substantial efforts to introduce both monetary and fiscal measures by Chinese policymakers on September 24th sparked a pretty massive rally in equity markets, with the index posting a 24% gain in September. That was the second largest monthly return for the index in the last 20 years. Now, while many countries, I think, have experienced a very strong economic recovery following the pandemic, China's economic performance has been uneven at best. Economic growth in China has fallen, I think, short of government growth targets, and the country is facing deflationary pressures. I think the lackluster performance of the Chinese economy and markets, I think, is multifaceted. But I think one key factor that's weighed on activity levels is the weak credit demand that we see from businesses and consumers. And many point to a depressed real estate market as the main culprit that's causing this malaise in the second largest economy in the world. You need to note that real estate contributes more than a quarter of China's GDP, and residential real estate represents an overwhelming share of household net worth. In a recent article, Bloomberg did estimate that there were over 60 million unsold apartments in the country, and that without government intervention, it would take more than 4 years to sell all the units. So with this degree of excess inventory, residential property prices have fallen on a steady pace and are down, call it 15% since their peak levels in late 2021. This chart illustrates the significant decline in home sales over the last 2 years. So consumers are experiencing a decline in net worth, which is obviously weighing on consumption levels and economic growth. To add to this, we're seeing real estate developers who took deposits to build properties under pretty intense financial pressure. The remaining assets of China's second largest property developer, Evergrande, are in the process of being liquidated after it collapsed under massive debts. And Country Garden, another large developer, appears to be on its way to doing the same. So Chinese officials have tried to intervene in the past to introduce various programs to support the real estate market, but there hasn't been a high degree of success. Now, this is a major issue for the Chinese government. Recall that the country's growth engine for the last 40 years has relied on exports and on investment in property and infrastructure tied to the migration from shifting China from a rural to an urban-based economy. However, if you look at China's latest 5-year plan for the economy, there has been a shift to trying to spur greater growth from consumer spending. Note that while household spending represents 60% of economic output globally, consumers' spending contributes less than 40% in the Chinese economy. So it's understandable that the Chinese officials want to stimulate spending habits that will provide the overall Chinese economy with a nice tailwind. This plan is falling short of expectations as captured in this chart. A weak real estate market has derailed consumer confidence, and Chinese retail sales are languishing. The pandemic certainly had a negative impact on the situation, but as you can see from the blue line, the steady growth trend evident from 2015 has largely been absent over the last 2 years. Which brings us to the next slide, and the stimulus blitz that the People's Bank of China announced in late September. The measures focus on reducing interest rates, providing banks with additional liquidity, reducing the down payment ratio on second homes, and injecting liquidity to purchase Chinese stocks. As we highlighted, the initial reaction from the stock market to the package was positive. But the common argument from economists and strategists has been whether the actions are sufficient to reignite consumer confidence, increase demand for credit, and avoid the deflationary pressures to persist. In the next slide, we try to frame the bull and the bear case on whether this is the start of a outperformance for the Chinese equity markets or not. The bull case starts with valuation. The valuation for Chinese equities are at depressed levels, and there's significant runway before evaluations match those of global markets. At the end of September, China's index was trading at 11 times forward earnings, a 13% discount to the emerging market index, and a 40% discount to the broader all-world index. The second argument ties into leadership positions Chinese companies have attained in several industries. One example is electric vehicles, where China's leapfrogged the likes of Germany and the US and built an impressive ecosystem to deliver products on a global basis. For investors looking for exposure to leaders in clean energy, e-commerce, and other industries, they need to consider investing in China. The bear case, on the other hand, would point to a couple of factors weighing on Chinese markets. First, geopolitical friction between China and most developed countries has risen in the last 5 years. and we've witnessed trade activity and investment flows trend lower. This does not bode well for a country that has relied so heavily on foreign export markets to transform its economy in the last 40 years. The second point is that investing in China is difficult. Given intense competition and an abundance of capital, the returns for investors are not particularly attractive. In a recent report, investment manager Bailey Gifford noted that of the roughly 8,000 listed Chinese companies, only about 600 or 8% have generated an average return on capital above 10% over the last 5 years. Therefore, it results in a relatively small universe of high-quality companies for foreign investors to invest in. From our perspective, we're not surprised by the massive rally in Chinese markets. We noted that investor sentiment was really poor, and any positive development was bound to create a fear of buying activity. The next slide touches on our final 2 points. This chart shows the earnings per share of the MSCI China Index. Notice that after earnings rose 7-fold from 2000 to 2015, the trajectory has been flat to down for the last decade. We think valuation expansion alone will not ignite a new bull market for Chinese stocks. We need to see companies grow earnings in a meaningful way in order to attract the attention of global investors. Lastly, we want to reiterate a point that we've made in past webinars. We strongly believe that in less developed markets like China, it's preferable to look at active investment managers who conduct fundamental analysis to invest in Chinese equities. We've come across a number of managers that have generated very good returns in the Chinese equity market, despite the fact that the broader index has been fairly lackluster. Now let's move to our second topic that will touch on the strong performance from multi-strategy hedge funds. Before we dive into the multi-strategy funds that have garnered a lot of attention, it'd be best if we provide a brief overview on hedge funds themselves. Hedge funds are considered an alternative asset class. The capital pools use specialized strategies across public and private markets with the objective of generating positive returns, and with those returns having a low correlation with the broader market. Hedge funds use financial leverage to augment returns, and as such, are required to have very effective risk management systems in place to avoid poor results. Given a broader range of investment risks, hedge funds were historically reserved for institutional investors. But over the last 25 years or so, we've seen high net worth investors increasingly allocate to various strategies. Lastly, we highlight that there are hedge funds that focus on different markets, whether it be equities, bonds, currencies, and commodities. On the next slide, we see the obvious reason for the multi-strategy name. These hedge funds invest in a variety of underlying investment strategies. At the core of a multi-strategy hedge funds, you have what is referred as the center book. Here you have one or more chief investment officers that allocate capital dynamically to the best opportunities and shift resources where needed most. Effectively executed, and multi-strategy funds provide excellent diversification across different markets and can generate uncorrelated returns to complement a portfolio invested in traditional assets. An interesting aspect of multi-strategy funds is that historically, these funds have generated the highest proportion of its returns from alpha, or the incremental return above what is generated by the broader market. In addition, low volatility of the returns has resulted in multi-strategy funds generating fairly impressive risk-adjusted returns. The next slide provides a glimpse of the positive investment flows into this category. Thanks to strong markets, assets for all hedge funds grew in the first half of 2024. However, the level of growth from investor flows has been a detractor for many strategies. The one exception would be multi-strategy funds that have had a growing interest from investors, with net inflows of $25 billion in the first 6 months of 2024. The next chart partly explains why investors have gravitated to multi-strategy funds. As you can see from the return quilt, multi-strategy funds have delivered very competitive returns over the last 3, 5, and 10-year period. More importantly, the chart on the right shows the 3-year Sharpe ratio by hedge fund strategy. The Sharpe ratio is a measure that calculates the amount of return earned relative to the amount of risk taken. The goal for all strategies is to have a high Sharpe ratio, and at 2.8, the multi-hedge strategy funds have delivered very solid returns without much volatility. We want to conclude on what we believe are the pros and the cons of multi-strategy funds. I think the advantage for allocating to multi-strategy funds is that, unlike some specialized alternative strategies that often prove to have too much correlation to traditional assets, multi-strategy funds are not, and really provide a source of added value to portfolio returns. The second is that investors gain access to top-tier investment talent across a spectrum of different markets, which is very difficult to replicate. In terms of disadvantages, the costs associated with hedge funds are quite elevated. It's quite common for funds to have a 2% management fee, a performance fee that captures a portion of their strategy returns above a certain threshold, and other associated fees. Given the cost to attract and retain talent, we suspect that these costs will continue to remain quite elevated. Another disadvantage is that liquidity features of these investment vehicles are quite limited. Most funds have constraints on when investors can redeem their investments, and we've seen the most successful managers add gates to capital pools to avoid their funds being used as sources of liquidity during bear markets. That summarizes my thoughts on recent developments in China and the hedge fund space, and I hope these topics have helped you shed some light on your portfolio, and I'll bring it back to Kathleen for questions.
Thanks, Frank and Krista, for providing this information and for turning on your mics. I'm going to stop sharing here, and then I'm going to go check to see what questions we have. So I have a couple of questions that I want to see what we've got here so far. So I'll start with this one that's come in. I'll send this to you, Krista. I think as an investor, should I be preparing for a potential recession or soft landing? And if so, how would you suggest I protect my portfolio in either of those cases?
So I think while we said that's not our central case, we're feeling a little bit better about things than that. We can't say it's zero to, there's still some risks we have to watch. So I think being aware of that risk means it's worth looking at your portfolio and making sure things are in good shape. What we tend to do on a regular basis, including now, even though we're mostly constructive, is we would maintain some cash on hand for people who need cash so that you wouldn't have to sell if there was a wobble in the markets or if things did turn down. And we can still make some money on cash. Eventually, those cash returns are going to come off, and that won't be the only way. But then the other thing is having some fixed income. There's been that debate because it hasn't been as strong a performer as equity, but we think there's an ability to, especially as cash returns come off, to have some fixed income in the portfolio that provides some income, and that also would be a defense against things going the other way. And then the other thing is to make sure you've got good diversification across markets and sectors and styles, so that if things did slow down, you've still got businesses that will do well in a slowdown. So all of those sort of defensive tactics are things we're looking at, even though we don't think a recession is our central case.
Right. Okay. Here's a question I'll direct to Frank. What percentage of the balance funds is invested in Chinese companies right now? Do we have comment on that?
I wouldn't have a specific number. It's a small amount.
Small amount, okay.
There's a small amount invested in China, which is part of the international component of that fund, but it's not a significant amount.
Just building on that question, for somebody who has exposure to their portfolio to the Chinese market, what's your comments on, should they reduce their allocation given the Chinese housing market struggles, or do you think that the stimulus efforts that you were discussing is enough to support a recovery?
Yeah, I think we'd be invested in China, but I think to make a more pronounced allocation to the country, like I said, I would want to see a strong recovery in earnings.
Right.
I think that is, my general comment. But I guess, like I said earlier, I think there are, very astute, active managers that have been able to kind of siphon the strong performers, like the companies that have been growing earnings, growing their bottom line, that have really appreciated nicely, regardless of what's happening with the Chinese consumer or the overall economy. So yeah.
No, that makes sense. Krista, did any comments to add to that?
Yeah, no, I mean, I think it's hard. It's not going to necessarily be that big engine of growth that we saw before. So throwing all your money behind China would be a risky strategy. But on the other hand, as Frank started out saying, it's a big economy in the world, and there is a growing middle class, even though they haven't moved to as much consumer element of the economy as the US would have. That is a reason that it's worth looking at and worth considering those companies. And as Frank mentioned, if we can find managers that are doing a good job, even within our global fund, we have a manager that has an emerging market focus, and they've spent a lot of time in China looking at companies. And I think there are pockets where you can find some value, but I think, yeah, it's not going to be an easy ride, just because of the stimulus that came in.
No, makes sense. Here's a question just for you, Frank, on the multi-strategy hedge funds. How would you suggest that they could help my portfolio in, given the uncertain markets, and then building on that, what investor are they most suitable for?
Obviously, you have to have a degree of long-term capital. This is not an allocation that you would look to get in and out of. It's really a long-term allocation where you're obviously trying to kind of complement your traditional portfolio with something that provides you with, a high single-digit return, a return that's very complementary to an equity portfolio, but without the volatility. So, effective. And there are very effective strategies that we're aware of that have been able to kind of perform, relatively well when markets do poorly. So, this part of the portfolio is a kind of a bright spot in a dark market like we had in 2022. So that's how you would think of it, but it is a long-term investment. It's not something that you allocate to and then in a year's time you decide, I'm not happy with the returns, I need to move out. There's a lot of restrictions associated with them, which makes it difficult to kind of maneuver as you would in a traditional asset class.
Yeah, sometimes in portfolios, we're looking at sort of 0 to 10% in that type of strategy. And you have to have the ability to not need the liquidity, as Frank was saying, because there's usually restrictions on liquidity. And then the fact that there is leverage there, while those funds do have effective risk management, there is some extra risk because of the leverage. So, it's not appropriate for every portfolio, but it can help, as Frank said, and we did see that with some portfolios when other markets were down, it provided some benefit in it. There are also some managers that have done well. So that's usually where we're looking at it, sort of a 0 to 10% allocation, and may not even be in one strategy. It might be in that sector of the market, et cetera. So it can play a role, but it's not you wouldn't put all your money there.
No, that makes sense. Got to think about it. Just as the interest rates are expected to continue falling, how do you think this might impact bond holdings and others who are, have income-focused investments?
Yeah, I mean, some of the returns have been factored into the markets already, as you saw in the third quarter, some that anticipation of dropping rates, some of that has happened. I mean, interest rates coming down eventually will mean that cash returns will be down. I think a lot of people have been just so happy to rely on cash returns for a while. Eventually there'll be more reason to maybe keep a little bit less in cash and to keep some short-term fixed income to provide that kind of stable return for the portfolio. But I think on the other side, lower interest rates will help to fuel some growth in certain sectors. So it should help to lift a number of areas. So I think it's not just the fixed income. There's because some of that growth has happened, we're probably looking at, getting coupon rates of return plus a little bit of gains as opposed to massive gains in your fixed income section right now. But there's other reasons to maintain that fixed income, for stability and also for
Right.
that sort of black swan protection against things slowing down. So I don't know, Frank, do you want to add to that?
No, I think you've captured the high points. I mean, I think the markets, it's difficult to kind of understand what the markets is anticipating in the bond markets. Obviously, the third quarter, we saw markets kind of discount some of the fact that rates are falling. And now it's really, I think we're going to be in a guessing game for some time to understand, where rates are going to be going.
Right. No, that makes sense. So even though we didn't dig into it too much, I'm sure you have some comments here or can provide maybe some color on the potential impact of the upcoming US election. I think it's on a lot of our clients' minds. Maybe Krista, you want to take a go at that?
We did talk about it at a previous webinar.
Right.
But yeah, as people are probably aware from watching, there's a very close race happening in the US and there is some volatility that can go along with that. Both candidates' approach to things will likely keep debt levels fairly high for different reasons. I think there's a lot of debating right now about what tariffs will do to markets and what sectors will be impacted by tariffs if the Republicans are successful. And on the other side, thinking about impacts of corporate taxes and things. So I think the biggest thing is the volatility of people's uncertainty if they're not sure what's going to happen and what will happen. I think eventually the fundamentals in companies and the economy will win out over what happens in the election. But certainly people get a little jittery as they're not sure what's going to happen.
No, that's for sure. We're all waiting to find out. The next one here that I have, I think this might be, well, I'll put it out to either of you. It might be more along Frank's topic. Should I consider diversifying my portfolio more globally? And if so, which international markets are offering the best opportunities right now?
Well, I think we've spoken about both emerging markets and international markets. I think, when you kind of compare when you look at global markets, obviously the US is a big component of that.
Right.
But if you look at international markets, whether it be emerging or developed markets, the valuations are far more attractive. Arguably, the growth is far more, stronger in the US, and understandably why valuations are higher. But I think if you look at parts of Europe, Japan, Japan's been of interest as we're seeing a bit of a shift in terms of corporate culture there, corporate governance. It's a stock market that's had a nice period of time, and if that has legs, if we're going to continue to see stronger corporate governance and a focus on generating shareholder value, which hasn't been, I guess, part of the culture in Japan. That could be a nice tailwind for that country. In emerging markets, we've talked about India. We think it's got long-term structural benefits that are favoring that country. So those are kind of some of the countries. But I think internationally, from a valuation perspective, there's more pockets of opportunity than I would say in US markets, given the valuation, the divergence.
Yeah, and I think that doesn't mean we would be absent ever the US. The US is a great economy and has lots of good companies. So you would have some there. But as Frank mentioned, there are some opportunities outside of the US now in the countries that he's mentioned. So introducing some of those back in the portfolio gives you that diversification, which allows some opportunities to be realized, I think.
No, that's good to think about. And just before, I have one last question. And Frank, you were talking about the benefits of hedge funds as diversifiers. How do you decide whether it's worth the higher fees and the liquidity constraints when you're considering this for a client's portfolio?
Obviously, there's a great deal of due diligence that we do just to kind of understand the validity of the investment strategies, the depth of the teams. There's a great deal of work that we do to assure ourselves that we want to kind of recommend an allocation to hedge funds that is it takes a long time.
Right.
And then obviously with the understanding that we're comfortable that, you know, with all those factors being addressed, that the return target is achievable. That
Right.
return is achievable. Obviously, we take that into consideration, and we kind of reconcile that with the fees, and we would recommend moving forward. But like I said, there's probably a lot more due diligence on our part to kind of recommend such a low allocation because of the fee factor and the illiquidity factor as well, which I highlighted as a con in my presentation.
Sure.
Yeah, and usually again, because we're looking at the overall portfolio and trying to come up with an allocation that makes sense, we would again look at some range. You know, often with portfolios would be somewhere between 0 and 30% in all alternatives, and then the multi-strat hedge funds would be a part of that. And so we would try to risk manage things there, and then choose managers that can provide that greater return in excess of their fees and offsetting the risk that exists. So it's again some work to design where does it fit into the portfolio, and then making sure the client really understands it too. That's the other thing, you know, it's due diligence on our part, and then making sure we discuss it well.
Yeah, no, that makes a lot of sense. So I think we're getting close to our end. It's 1. So just last closing comments, Krista and Frank, before we end off today's webinar.
No, I mean, I think just, you know, we've been fortunate with the returns that have happened in the market this year, coming off of some prior tougher years. So that's been nice to see. But we still really want to be cautious in our outlook. We want to, you know, while we feel constructive, as we said, we still feel like there's, you know, we feel like there's some positive factors behind continued growth, but we're being careful because we know there is still some risk out there. And so having that diversified approach to your portfolio, thinking really about the long term and not getting caught up in what happens in any one week or month or day, you know, trying to really keep that long-term focus in mind, and then make sure there's good quality securities within the portfolio to help you achieve your goals. That's the most important thing, really.
Anything else to add, Frank, before we sign off?
Once again, Krista did a fine job in organizing everything. Thank you.
Stole your thought.
Well, thanks everyone for listening to our webinar. Thank you, Krista and Frank. Just a reminder, you'll get a follow-up email to everyone who attended today, and we will include an access of the recording for your information or to share. And if you have any other additional questions, please don't hesitate to give us a call. Thanks so much, everyone, and we'll see you next time.
Thank you. Bye.